Let's also bring on board David Pizarkar, Head Equities at Daiwa AMC, first in. David, I want to first start off with HCL Technologies earnings. I don't know if you've had the chance to take a look or not, but good set of numbers. Do you expect the markets to reward the stock as well?
Good morning and thank you for having me on the show. I'm afraid I will not be able to comment on individual stocks, but what we are seeing here is that we have a sort of a variation in terms of the outlook that we are seeing from the two major IT companies. One will have to exactly look into different business segments and see what is contributing where and where the margin uptick is being realized. Apart from that, I'm afraid individual stocks I will not be able to comment on. But for the IT sector as a whole, there have been two important negatives that have sort of cropped up. One is that the rupee, which was expected to depreciate over the course of the next few months, that is increasingly unlikely because of the fall in the commodity prices that we have seen. And secondly, the draft immigration bill, which has been proposed in the US Senate, is likely to create some sort of a pressure in terms of the employment costs. So for the sector as a whole, I think there are a few clouds emerging there.
So at a broader portfolio level, do you think it's time to take some chips off the table now?
I think it is time to realign a little bit. I think the expectation of macros continuing to remain weak, that has changed because of the fall in commodity prices, and the possibility of a further easing in the monetary policy has certainly cropped up now. So I think one can move away just a little bit from the rupee dependent sectors, more to domestic focused sectors, particularly public sector banks, which continue to remain at attractive sort of levels, and see some kind of realignment there.
But David, is it too early to switch sides just because crude and gold have fallen? Yes, optically macros will look better, but for macros to look better, a lot of other things also need to change.
Well, yes, absolutely. And apart from that, this fall that we have seen in the fall that we have seen in the commodity prices over the past few days needs to be sustained. But at the same time, the fears relating to a spiraling out of the current account deficit, those have stemmed away. Every 10 barrel fall in the crude oil price is going to lop off around 0.5% of the current account deficit and around 0.4% of the subsidy bill. And if the government goes ahead and freeze diesel prices, then we have a added positive. Yes, we need to see a pickup in infrastructure investment. We need to see a revival in terms of capex, and of course the earnings season, or the earnings expectations for financial year 2014 will most likely need to be pared down. But at the same time, we have overall market valuations which, on a price to book kind of a multiple, seem to be at their lows, from which they have rallied earlier. So I think what we will see is a range bound kind of a market, and as of now it seems to be nearer to the bottom of that range. But as we get maybe around 10% higher, then again people will start looking at political uncertainties and earnings uncertainties. So we will most probably be confined to a range bound kind of a market.
What are your thoughts on consumer names? Because consumer companies will start coming out with their numbers next week. Do you expect something special from consumer names this time?
Well, we always have this dilemma in our minds, because consumer staples continue to trade at extremely high valuation multiples, and even if you compare staples multiples in India with their counterparts abroad, then here we see very high kind of levels. On the other hand, they are the only sector where earnings growth has been consistent, and one has some kind of a visibility going forward as well. Now this quarter, I think what will happen is that consumer companies will see some expansion in terms of their margins, because input costs seem to have tapered off. On the other hand, I think volumes will continue to be sluggish for the second quarter running. So I think we will see a kind of a dispersion in terms of their performance, with some of the smaller Indian companies seeing stronger growth there. So we are more biased towards the Indian consumer names rather than the MNCs at this point of time, because we think that we will see more consistent growth there, and on a relative basis their valuations seem a little bit more attractive to us. On the other hand, in the discretionary space, as far as the autos are concerned, we have seen a sharp kind of a slowdown there. So in terms of earnings, I don't think we will see any positive surprises there. But on the other hand, in the media space, where one has a very clear earnings visibility there, and plus there has been a sea change in terms of the digitization that we have seen, there I think we are quite positive on that sector, and we would look at the broadcasters there with a very positive viewpoint. So that is the broad take that we have as far as the consumer sector is concerned. All the commodity consuming companies are obviously going to benefit, but what we have seen is the underlying demand conditions have been very challenging for these companies. So because of the high level of competitive pressure, I think what we are going to see more and more is that most of these companies will have to pass on most of their gains to their end consumers. But on the other hand, if you see, because of a easing of monetary policy, reduction of interest rates, etc., if you see a revival in the underlying demand, then that will be a indirect positive for these companies. In terms of the ancillary companies, we are more inclined there. So we are positive on the tire companies and companies which are serving the ancillary sector.
David, what's the expectation in terms of the banking pack's performance, and also what the RBI may do now that inflation seems to have bottomed out? Can we expect a rate cut? Because something's got to justify the movement that we've been seeing in the bank nifty day in and day out.
Yeah, absolutely right. I think we are looking to a 25 basis point kind of a rate cut in this forthcoming policy, and there were fears in terms of the public sector banks' levels of NPAs. Now, from what we have heard from the largest bank yesterday, I think if the recoveries are more than offsetting the incremental NPAs, then I think that will be a positive as far as the public sector banks are concerned. And of course, this particular pack of banks is more inclined to move in line with improved expectations in terms of the economic recovery. So if those expectations rise, then I think we will see public sector bank stocks staging some sort of a rally from here. But then, at least until we get a very clear view, these public sector banks particularly will remain in a range-bound kind of a environment. Whereas private sector banks, of course, we are expecting a consistent 20 to 25% kind of profit growth there, and a bit of an improvement in terms of their NIMs.